Hey guys, in this video I'm going over our exit rules, being both our take profit and our stop loss. So these are very mechanical rules, aka set in stone that we do. So there's not much explaining on the reason behind. This is just statistically, this is what works best over thousands and thousands of back tests. So let's discuss it. First is our stop loss rule. This helps us mitigate our loss so that every one winner will offset one loser and vice versa. So how we set this up is we exit when our strike price is broken. As you remember, when we're setting up trades, we pick a level we think the stock will stay above. For instance, let's say we're placing a put credit spread trade right here. We go below it and we find a level we think the stock will stay above. So just for example, let me just put a line here. So if we think the stock will stay above this level and the stock then comes down and breaks this level, hits this level and goes below it, that means that the trend is no longer intact. The trend that we were trading, aka the uptrend here, if we're placing a put credit spread, is no longer intact. So we should exit that trade for a stop loss. So when we exit the trade, when our strike price has been hit, that means that the spread will be trading around 50 cents. Now there's a theoretical reason for this, but all you need to know is when your short strike price is being hit, the stop or the spread price will be between 45 cents and 50 cents, around 45 cents. So that's the price that it will be. So that is the price that we're going to set for our stop loss. So how do we set this up exactly? Well, I have a trade here that we can do it with. What I must caveat this and say is that only certain brokers allow you to place stop limit orders on credit spreads because they are two-leg option trades, which means they have two different types of options in the trade. So how do we adjust this accordingly? I will show you how to deal with it if your broker does not allow you to do a stop limit order, like a Robinhood broker or something like that. So for instance, I'm using a Tastytrade for this example, so I will be able to. So I click on this vertical trade right here. I click on the close position. I'm going to go over here. Let me move my mic so I can fully see my screen. So let's see, close position. Order type here, we're going to move that to stop limit. We're going to move that to a net debit or stay at net debit because that means that debit means we're exiting since the credit's enter. Just making sure my face isn't covering bad things. Anyways, so now we have a good till cancel. The reason being is because we don't know how long this stop loss will be open. We just know that we want it to stay open while we are in the trade. So we're going to do a good till cancel order. Next, we have the stop trigger price and the limit price. So when you're putting on a stop limit order, there's always two different prices. The reason for this is because when you're putting in an options order that's above the current price, it will automatically fill because of the way that the options market works. So what we need is we need a trigger price that when that price is hit, then our order gets sent into the market. If it's sent in before, automatically will get filled, and we don't want that. So that's why there's a trigger price. When the spread price hits this trigger price, then we'll send the order in. So if we're looking at the stop trigger price, and we'll remember we're trying to exit at 45 cents, so that remember that's our exit. If we're trying to exit at 45 cents or somewhere around there, that means once the spread hits, let's say 45 cents for example, now that's our trigger price. So once the spread has traded at 45 cents, now our order will get sent in. Well, what order will get sent in? This limit order, which shows where we're going to get filled. And so again, if we're trading at 45 cents, and we are trying to buy back into the market, we typically want to buy a bit higher to get filled instantly, right? If we go down a bit lower below 45, it may take some time for us to get filled. So for that, we can go around 40, we can go 45. If we want to fill instantly, we can go 46 or 47, but something like this would be a great order to set up. And so this is how you set up a stop limit order. You simply click review and send, and that is your order done. You are good. So again, this can be done on Tastytrade and TD Ameritrade, and to my knowledge, it may be available on Interactive Brokers, but that is how you set up a stop limit order. Now, for those who have a platform like Robinhood, how do we take advantage of it? Well, you need to go down to the stock that you're trading, not the options, the stock. And Robinhood now has the ability to set up alerts. You're going to want to set up alerts on the trade. And so again, you can set up price alerts. You can also set up indicator alerts. We're going to do a price alert, which means that, let's say if we're trading a put credit spread, that means we want the stock to stay above a certain level. So if the price moves below our strike price, whatever that price is, let's say it's 410, right? Now we set up the alert. So now we get alert triggered to our phone or computer or whatever, and now we know to go in and manually close that trade. So that's how that works. You can also place the alert on your broker or on TradingView or something like that, so that now you have an alert telling you when to get in. If you want more time or you want to be aware when the stock is getting close to your strike price, let's say our strike price is 410, then set it at 411. So okay, in your mind you can know it's getting close and you may have to worry about it. Well, that's the option if you don't have a stop limit order, aka a stop order that you can put in for your option. All right, I hope that makes sense. I will be introducing a way very soon that we can automate the orders for you, which I'm super excited for. But anyways, that is how we deal with stop loss, as explained here in the PDF guide that explains everything about the mother strategy. Next, we have our early exit rule, which is this right here, which simply says that if we can exit the trade for less than 6 cents or less than 5 cents, then we should exit the trade. Why? Because it's better to take our winners off while they are winning and then to reinvest the money into a new trade and continually roll the process like that. And so again, this statistically increases our win rate. So by default, it's around a 72% win rate for the put credit spread strategy. When we use the early exit rules, now that win rate is going up to 76%. So again, it is just more advantageous to close these trades because you never know what's going to happen. So if you have the profit, aka the spread is trading for less than 5 cents, go for it and close that trade. All right, guys, that is how we manage our exit rules, both a stop loss and exiting for a profit. I hope that makes sense. If not, message me in Discord and I'll get back to you. Anyways, I will see you in the next lesson.